Welcome to Charged Alpha, the S&P 500 stock encyclopedia. Today we are going deep on the world's largest defense contractor, Lockheed Martin, ticker LMT, Q1 2026 earnings results.
I'm Lana Chen. Q1 2026 just dropped, and the numbers have the street talking. Revenue of $18.02 billion came in below the $18.22 billion estimate. EPS of $6.44 missed the $6.74 consensus.
But here's the bigger picture. Lockheed Martin sits on over $160 billion in contracted backlog. That is more than 2 full years of revenue already locked in. Very few industrial companies in the world can say that.
NATO allies are accelerating defense spending past 2% of GDP. Ukraine reshaped European security policy overnight. Indo-Pacific tensions are driving Japan, South Korea, and Australia to dramatically expand military budgets. Lockheed is at the epicenter.
The F-35 Lightning II is the centerpiece. 17 partner nations, over 3,000 jets in the long-term program plan. Not just production revenue, decades of sustainment, upgrades, and pilot training flowing behind each delivered aircraft.
That sustainment cash flow is the real prize. Every F-35 delivered creates a 30 to 40-year service life of maintenance contracts, spare parts, software upgrades, and training services. The jet's unit economics are enormous when you count the full life cycle.
Let's set the stage. Q1 2026 was not a blowout quarter, it was a transitional one. Margins compressed near term, free cash flow was seasonally negative, but the structural demand story is intact and arguably accelerating beyond any prior cycle. Before the numbers, let's understand what Lockheed Martin actually is. The company traces its origin to the Lockheed brothers in Santa Barbara. But Lana, you've been digging into the founding story. Take us through it.
Lockheed Martin traces its roots to 1912, when aviation pioneer Glenn Lockheed founded his first aircraft company in California. The landmark event that created the modern company came in 1995, a $14 billion merger of Lockheed Corporation and Martin Marietta.
That deal created an aerospace and defense titan with no real competitor at its scale. Headquartered in Bethesda, Maryland, Lockheed employs 121,000 people and touches virtually every major U.S. defense program.
The company operates in over 50 countries worldwide. Revenue is spread across air, land, sea, and space platforms. No other defense contractor has simultaneous prime positions in all 4 military domains at this level of scale and program concentration.
The company is listed on the New York Stock Exchange. Today's market cap is approximately $122 billion. At roughly $530 per share, LMT carries a beta of just 0.24, among the lowest in the S&P 500.
That near-zero beta is a feature, not a bug. When equity markets sell off, Lockheed barely moves. Government contract revenue does not fluctuate with consumer confidence or interest rate cycles. These are sovereign customers who cannot cancel, even in a recession. CEO James Teichlet took the helm in 2020. West Point graduate, former Air Force pilot, and former CEO of American Tower Corporation. His background in aerospace and digital infrastructure is uniquely suited to Lockheed's transformation agenda.
Teichlet's 21st century security strategy fuses artificial intelligence, advanced networking, and computing into defense platforms. He is driving the F-35 from fighter jet to connected battlefield node, attracting significant new contract vehicles.
His key initiatives include the Long-Range Hypersonic Weapon Program, the Hypersonic Attack Cruise Missile, and Next-Generation Missile Defense Interceptors. Space segment classified programs round out a portfolio that will define Lockheed's contract pipeline into the 2030s.
Under Teichlet, Lockheed has also deepened its commercial technology partnerships. Collaborations with Microsoft, AT&T, and other tech firms are integrating AI and 5G connectivity into battlefield platforms. That is a pivot that legacy defense firms are only beginning to execute. Revenue trend across 8 quarters. Q2 2024 opened at $18.1 billion. Q3 2024 dipped to $17.1 billion. Q4 2024 rebounded to $18.6 billion on strong year-end program deliveries and milestone completions.
That Q3 dip and Q4 surge is a recurring pattern for Lockheed. Program milestones and government fiscal year end in September drive an acceleration in deliveries and billings in the back half of every calendar year. Investors learn to expect this rhythm.
The 2025 arc continued the pattern. Q1 in 2025 was $17.96 billion, Q2 2025 $18.16, Q3 2025 $18.61. Then Q4 2025 was the standout, $20.33 billion on accelerated F-35 and missile deliveries at year-end.
Q1 2026 stepped back to $18.02 billion, essentially flat year over year. That looks soft on the surface, but it reflects delivery timing and Q1 seasonality rather than any erosion in underlying program health or backlog strength.
Revenue here is contract delivery driven, not market driven. A single large F-35 delivery batch or satellite handoff can swing a quarter by hundreds of millions. The full year 2026 consensus of $74 to $78 billion implies solid growth from fiscal year 2025.
It is also worth noting that Lockheed raised its full-year revenue and EPS guidance when reporting Q4 2025 results. Management's confidence in the annual outlook remained intact, even after Q1 came in slightly below consensus. That is an important signal for investors watching guidance credibility.
EPS history now, and this is where the story gets complicated. Q2 2024 and Q3 2024 were clean beats, 685 and 680 actual, beating estimates of 652 and 650 respectively. Reliable, steady performance in those two quarters.
Then Q4 2024 delivered a shock, 222 actual versus 322 estimated. A large non-cash write-down on a classified program drove that miss. It was painful for shareholders, but explicitly identified as a one-time item, not a trend.
Q1 2025 snapped back strongly, 728 actual versus 636 estimated, one of the cleaner beats in recent memory. The forward EPS projection at that point suggested the company was back on track toward $25 to $28 annual earnings.
But Q2 2025 delivered another shock, 146 actual versus 680 estimated. A contract accounting adjustment in aeronautics wiped out nearly an entire quarter of profit. Again, explicitly one time, again, painful. The pattern of episodic volatility frustrated many institutional holders.
Q3 2025 recovered sharply to 695, beating the 638 estimate. Q4 2025 missed at 580 versus 707. Q1 2026 missed at 644 versus 674. The forward EPS projection for full year 2026 is in the $26 to $28 range.
Normalized for one-time charges, the quarterly EPS run rate has been consistently in the $6 to $7 band. Annualized, that is $24 to $28. At today's price, you are paying roughly 19 to 22 times normalized earnings. Not expensive for a defense prime.
Margins. Q1 2026 gross margin was 11.53%, operating margin 11.45%, net margin 8.26%. All softer than Q1 2025, which printed gross and operating margins above 13% in a cleaner quarter.
The margin compression in Q1 to 2026 reflects two forces: a mix shift toward lower margin development programs and continued friction from F-35 TR-3 avionics software. Block 4 integration has been more complex than originally scoped. A known risk management is actively working through.
On a trailing 12-month basis, the EBITDA margin runs about 10.8%. Gross profit margin is 9.8% trailing. On a near $75 billion revenue base, those percentages represent billions of absolute dollars in earnings power.
For context, Northrop Grumman runs higher gross margins because of its software and B-20 program mix. RTX benefits from higher margin commercial aftermarket. Lockheed's lower margins reflect its concentration in large, cost-intensive hardware programs like the F-35.
That is not a negative, it is a scale trade-off. Lockheed trades lower margins for higher absolute revenue and backlog. The question is whether margins expand as the program mix matures and lower margin development contracts roll off.
Management has guided for aeronautics margins to improve as TR-3 software deliveries resume through mid-2026. The full-year operating margin target is 11 to 12%, modest sequential recovery that sets up a better-looking 2026 annual comparison. The interest coverage ratio stands at 6.6 times on a trailing basis. Comfortable, not stressed. With the balance sheet now near debt-free after Q1's restructuring, future interest costs shrink materially and free cash flow conversion improves.
The dividend per share on a trailing 12-month basis is $13.50. That yield of 2.5% at today's price is modest by bond market standards, but the dividend growth track record is what sophisticated income investors care about most. Return on invested capital of about 17% compares favorably to industrial peers. Return on equity looks elevated because pension-related losses have compressed stated book equity. The ROIC figure is the cleaner measure of underlying business performance.
Cash flow picture. Q1 is always the weakest quarter for Lockheed by design. Operating cash flow was just $220 million, and free cash flow was negative $291 million. Capital expenditures of $511 million drove the negative print. The comparison matters. Q3 2025 generated $3.7 billion in operating cash flow and $3.3 billion in free cash flow. Q4 2025 delivered $2.8 billion in free cash flow. Lockheed is a Q3 and Q4 cash generator. The annual figure is what to track.
The company has historically delivered $6 to $7 billion in annual free cash flow. That implies a free cash flow yield of roughly 5 to 6% at today's market cap. For a defense prime with over $60 billion in backlog coverage, that yield is attractive.
Balance sheet. Total assets are $59.2 billion as of March 2026. Cash stands at $1.89 billion, and the biggest headline, total debt collapsed to just $168 million, down from over $21 billion the prior quarter.
That is a remarkable structural shift. Lockheed repaid $1 billion in long-term debt during Q1 and reclassified other obligations as part of a broader capital structure refinement. The net cash position is now effectively positive.
A net cash balance sheet at a defense prime of this scale is rare. It gives management maximum flexibility, whether that means accelerating buybacks, pursuing bolt-on acquisitions in hypersonics or space, or simply protecting dividend growth through any near-term earnings volatility.
Equity stands at $7.5 billion. The accumulated other comprehensive loss of negative $7.5 billion is almost entirely pension-related. Lockheed's pension plans are enormous and closely watched. They swing book value significantly based on discount rate assumptions.
Current ratio is 1.14, just above 1. That is adequate, but not a buffer of comfort. Working capital is tight because of the nature of government contracting, where much of the receivables are locked into program billing cycles rather than standard commercial terms.
Capital returns. The annual dividend is $13.50 per share, a yield of 2.55% at today's price. Lockheed has grown its dividend for roughly 20 consecutive years, making it one of the most reliable dividend growers in the industrial sector.
In fiscal year 2025, Lockheed returned approximately $2.25 billion via share repurchases across 3 quarters. Q1 to 2026 saw no buybacks as management prioritized debt reduction. With the balance sheet now lean, buyback resumption is widely expected in the second half of 2026.
The trailing payout ratio is 66%, sustainable at current earnings and leaving meaningful room for dividend growth. Management has consistently communicated a capital return commitment. The mix between buybacks and dividends shifts quarter to quarter, but total return remains a priority.
The interest coverage ratio stands at 6.6 times on a trailing basis, comfortable, not stressed. With the balance sheet now essentially debt-free after Q1's restructuring, future interest expense should be minimal. That frees cash for dividends and buybacks going forward.
Return on equity is high, but somewhat artificial given the negative accumulated comprehensive income depressing book equity. Return on invested capital of about 17% is the better lens here, and that figure compares favorably to most industrial peers.
Analyst Consensus. Of roughly 20 analysts, 6 carry buy or equivalent ratings, 12 are hold or neutral, and 2 rated a sell. The consensus price target is approximately $590, about 11% above today's $530 price.
Recent moves: Truist Securities upgraded to buy in January 2026. Susquehanna maintains positive. Goldman Sachs has held its sell since early 2023 on valuation. JP Morgan downgraded from overweight to neutral in December 2025 after the Q4 miss. Jefferies holds it hold.
The distribution of ratings is healthy. No extreme consensus in either direction. The stock is not a crowded trade. Bears have ammunition around execution risk and budget politics. Bulls point to backlog, defense tailwinds, and forward earnings valuation.
Wall Street's caution on LMT is largely about execution consistency. The 3 earnings misses in the last 5 quarters have tested patience. Until Lockheed strings together 2 or 3 clean beats with margin recovery, the street will stay in neutral territory.
That creates an opportunity frame. If TR3 software deliveries normalize and aeronautics margins recover in the back half of 2026, the stock could re-rate toward analyst targets near $600. That is a 15% move from current levels, plus the 2.5% dividend.
Valuation. At 25 times trailing earnings, LMT is not cheap in absolute terms. Price to sales at 1.6, EV to EBITDA at roughly 15 times. These multiples are fair but not compelling if you anchor to trailing numbers that include those one-time charge quarters.
The forward lens is more interesting. On 2027 consensus EPS of roughly $32 per share, LMT is trading at about 16.5 times. For a company growing earnings at 8 to 10% annually through 2030, that multiple is quite defensible.
When comparing LMT to its rivals, the picture sharpens considerably. RTX, Raytheon Technologies, trades at roughly 36 times trailing earnings with a $145 billion market cap. RTX benefits from commercial aerospace exposure via Pratt & Whitney engines.
Northrop Grumman trades around 28 times with an $83 billion cap. Their crown jewel is the B-21 Raider stealth bomber, a sole-source contract that provides extraordinary multi-decade revenue certainty. They are the purest large-cap defense play in the peer group.
General Dynamics is the value name at roughly 19 to 20 times earnings and $86 billion in market cap. Gulfstream business jets provide a non-defense offset. Abrams tanks, Virginia-class submarines, and Stryker vehicles round out a solid, diversified portfolio.
Boeing's defense arm is a wild card. Execution challenges, labor disruptions, and years of cash burn have complicated the enterprise picture. F-15EX, Apache, and KC-46 are solid programs, but Boeing as a whole trades at distressed-like valuations until commercial recovers.
Lockheed wins on scale of contracted revenue and program diversification across all 4 domains: air, land, sea, and space. No other pure-play defense prime matches the combination of F-35 depth, missile defense breadth, hypersonics positioning, and classified program exposure.
Segment Deep Dive. Aeronautics, roughly 39% of revenue. The F-35 Lightning II is the global standard for multi-role fighter capability. 17 partner nations, over 3,000 jets in the program plan. Sustainment contracts alone stretch decades into the future.
Aeronautics also operates the C-130J Super Hercules transport fleet and classified advanced programs. Margin pressure in recent quarters comes directly from F-35 TR-3 avionics delays. Management expects resolution through mid-2026, which should restore aeronautics margins toward historical levels.
Missiles and fire control is the hottest growth segment today. PAC-3 Patriot interceptors are in extraordinary demand as Europe rebuilds air defense stockpiles. HIMARS rocket systems are backlogged for years. Javelin production is running at maximum capacity. This segment is benefiting directly from global rearmament.
MFC also holds Lockheed's hypersonics franchise. The long-range hypersonic weapon for the Army and the hypersonic attack cruise missile for the Air Force are among the most strategically significant programs in the entire U.S. defense budget. Production scale-up drives segment growth through 2030.
Rotary and Mission Systems covers the Sikorsky helicopter family, Black Hawk, Seahawk, CH-53K King Stallion, plus naval combat systems like Aegis and the THAAD terminal defense platform. THAAD is being procured by Saudi Arabia, UAE, and South Korea, adding meaningful international demand.
The space segment is underappreciated. GPS-3 satellites, overhead persistent infrared missile warning systems, the next-generation interceptor for homeland missile defense, and classified national security payloads, space represents about 19% of revenue with above-average long-term growth potential.
Across all four segments, management's message is the same. Demand exceeds current production capacity. The constraint is not orders, it is manufacturing throughput, skilled labor, and supply chain. That is the ideal supply-demand dynamic for a contractor heading into a multi-year spending cycle.
Bull case. Defense spending is a secular trend. Ukraine and the Indo-Pacific have made clear to every U.S. ally that underinvestment in defense is existential. Political will to sustain large defense budgets transcends party lines in most democracies. That is the macro foundation.
F-35 international expansion is still in early innings. Poland, Germany, and Finland are placing substantial new tranches. Japan and South Korea are expanding existing orders. Each new international delivery adds not just production revenue, but decades of sustainment contracts on top.
Hypersonics is the next multi-billion-dollar growth market. The U.S. accelerated programs after Russia and China demonstrated the technology in combat scenarios. Lockheed holds prime positions on the most critical U.S. hypersonic weapon programs, a market that barely exists today at production scale.
Bear case. U.S. budget politics remain a real risk. Any prolonged continuing resolution or debt ceiling standoff can delay program funding. Lockheed's revenue is contract delivery driven. Government payment delays compound near-term cash flow softness directly.
F-35 execution risk persists. TR-3 avionics delays have already driven earnings misses. Fixed-price development contracts mean Lockheed absorbs cost overruns, squeezing margins when engineering complexity exceeds initial scope estimates and timelines slip.
Customer concentration is the structural bear argument. When 70 to 80% of revenues come from one customer, you inherit their budget cycles, procurement timelines, and political environment. There is no market diversification hedge to fall back on.
The geopolitical de-escalation scenario is the tail risk. If a Ukraine ceasefire holds and tensions ease in the Indo-Pacific, the urgency behind NATO rearming could slow. That would not crater Lockheed. The backlog is already booked, but it would compress future order intake.
Insider and options activity data was unavailable from our data source this quarter. Historically, Lockheed insiders have been net sellers on the open market, consistent with long-tenured executives managing large vested positions, not a signal of concern about the business.
Closing frame. At $530 per share with a 2.5% dividend, a recovering buyback program, and over $160 billion in backlog, Lockheed offers compelling total return potential for patient long-term investors.
The forward earnings trajectory is the key variable. Analysts project EPS of roughly $26 in 2026, $32 in 2027, $34 in 2028, and approaching $38 by 2030. At 16 times 2027 estimates, that is a reasonable price for a defense franchise with this runway.
The space segment is also growing in classified programs that analysts cannot fully model from public filings. The black budget programs, those that do not appear by name in public earnings releases, represent a meaningful and growing slice of Lockheed's space revenue.
The four-segment structure provides natural diversification within the defense budget. When aeronautics faces headwinds, missiles and fire control offsets it. When space matures, it becomes a bigger share. That built-in rebalancing is a structural advantage over single-program contractors.
Program concentration within each segment is actually a strength, not a weakness. The F-35 alone funds decades of engineering talent and manufacturing infrastructure. That scale creates cost advantages, IP moats, and operational barriers to entry that no new competitor can replicate. Lockheed Martin is not a momentum trade. It is an industrial fortress, sovereign-backed, deeply entrenched, and methodically compounding capital returns for shareholders. The backlog is the moat, and the geopolitical environment is the tailwind. That combination rarely comes cheap.
This podcast is for informational and entertainment purposes only and does not constitute financial advice. The information presented reflects data available at the time of recording and may not be current. Always consult a qualified financial advisor before making any investment decisions. Charged Alpha and its hosts may hold positions in securities discussed. Past performance is not indicative of future results.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.